Hello, this is Josh Wolberg with Great River Financial, and this is the third quarter update of 2022, or what we like to call What in the World Happened. So in the third quarter, trends continued. US, non-US stocks and bonds all went down in the third quarter as they did in Q1 and Q2. Stocks were down more than bonds. If we zoom out a little bit more and we look at the one-year numbers, which includes the fourth quarter of 2021, a diversified portfolio of global stocks are down basically 20 to 25%, bonds 10 to 15%. Now, it's not that unusual for stocks to be down 20 to 25% in a 12-month period. We've experienced that multiple times in our investing lifetime. Bonds being down 10 to 15% is new and somewhat unusual. We'll talk about some of the historical context for both stocks and bonds. We'll also talk about some possible optimism for both going forward, even though 2022 has been obviously a very challenging year. All right, so what really drives long-term stock returns are earnings growth on the underlying companies. If you look at from 2001 to 2021, there's been about a 9% increase in earnings on average of the S&P 500 companies. And the returns have been about 8.5%, so less than a 1% difference. So the market tends to be quite rational and logical over a long period of time. Individual years, though, there can be a big disconnect. So in 2020, the first year of the pandemic, earnings on the S&P 500 actually shrunk by 22%, so it declined. And even though stock prices went down 30% in just March of 2020 alone, it more than recovered by the end of the year and was up by 16% overall. So about a 40% disconnect between earnings and stock prices. Now, what some people were predicting in 2021 as a result is stock markets were going to go down as a result of bad earnings growth or shrinkage in 2020. What actually happened in 2021 is earnings growth accelerated to 70%, which means that almost doubled year over year earnings on the S&P 500. And prices of stocks only went up by 27%. I say only because it's 40% disconnect between what actually happened to earnings. Now in 2022, earnings are basically flat and prices are down, 19, 20% depending on the day that we're looking at. So over the last 3 years, we've basically had that, earnings growth of about 9% on average, although obviously very volatile, and prices have not kept up with it. So what's likely to happen in the future to stock prices is really a function of what happens to earnings. If companies continue to innovate, come up with new products, new services that they're able to market to new customers, their revenue will go up. If they can figure out a way to do that efficiently from a cost perspective, their earnings are going to go up over time because revenue grows more than expenses do. Now, when we look at the bond market, there's a real disconnect here between what's happened in market history. There's a real outlier, 2022 being down almost 15% in US bonds. You'll look at just the last 40 years, it's very seldom to have a negative year in bonds at all, let alone more than 1% or 2%. And this is really the worst bond performance of any of my clients' lifetimes. There is a silver lining, though. And just as earnings in the future tend to drive future stock market performance, interest rates today tend to drive future bond performance. So if we look at interest rates that have gone up dramatically this year, a 5-year treasury bond at the end of 2021 was only yielding 1.25%. Now that same bond is yielding 4.25%, so 3% more per year. So even though it's been really unpleasant having bond prices go down 10 to 15% this year, if it gets another 3% per year through higher interest rates over the next 5 to 10 years, you can actually end up with better returns on bonds the next 10 years as a result of what's happened this year, bond prices going down and interest rates going up, because interest rates are similar to earnings and stocks. They're a big component of future bond performance. And why have interest rates gone up so much? It's really inflation, right? So inflation, you'll see, started to go up really in the beginning of 2021 and kind of crescendoed in mid of 2022, and it started to come down a little bit. The Fed is trying to increase interest rates to tap down the growth in demand for goods and services, not necessarily cause a recession, but to slow the growth of demand as we come out of the pandemic, right? Economically, at least. So, but supply chains aren't quite where they were in 2019 yet. There's made a lot of improvements there, but they're not quite to where they were. So prices are all a function of supply and demand. Demand continues to grow, even though the Fed's trying to, rein it in a little bit, and supply hasn't gone back to where it was. So that's really why inflation is still relatively high, even though it started to come down. So it's going to take some time to to basically get through the fact that interest rates take a time, there's a lag, as well as it's going to take some time to get supply chains back to where they were. All right, so let's look at a 60-40 portfolio, 60% stocks, 40% bonds. It's not unprecedented for it to be down 10+% in a particular period, but it's not exactly common either. So it's happened about 11 times in US history over the last 100 years. And when we look at, the Great Depression are obviously the two worst of those, how long does it take to recover during a time like that? So it took about 4 years, the first period of the Great Depression. It took about 5 years, the second period of the Great Depression. All these other times, right, are basically 2 years or less. Now, I'm not saying the recovery from this is going to take 2 years or less. History doesn't always repeat itself perfectly, but it does tend to rhyme. So when markets turn around, right, both stock and bond markets are likely to turn around at some point. When that happens, the recovery might be faster than we expect. And the recovery in investment markets might come before the recovery in the economic markets. In fact, that happens a lot. If you think back a few slides, when we were talking about 2020, even though the earnings on the stock market were down in 2020, the market went up, right? And the earnings acceleration didn't really happen until 2021. A lot of times that's how it happens when we have a recovery, is that the market starts to perform better before we have good news in the economy. Again, we don't know that's what the future holds, but the past does give us a lot of input on how these things usually play out. All right, so how do we invest in a volatile market? The same way that we do in every market is we make sure that clients that are taking money out of their investments have enough cash and enough bonds for short and intermediate term needs. So for the next year, the next, say 1 to 10 years for bonds, to have enough in there to weather storms in the market. Dividends and interest, do we reinvest them or leave them in cash? It depends on your situation. So if you're in retirement, we're going to leave them in cash. They're going to replenish that buffer of cash. If you're in the accumulation stage, as dividends and interest come in, we're going to reinvest that in the part of the market that you don't have enough of, depending on what's happened in both stocks and bonds. We're going to rebalance over time. So if you get out of balance, if your target's 80% in stocks and 20% in bonds, and stocks continue to do worse than bonds, we're going to need to sell bonds and buy stocks at lower prices, and vice versa. When stocks recover, they're likely to recover better than bonds. So we'll sell stocks as they go up to replenish the bond portfolio. Roth conversions make sense, for a lot of clients every year, right? But if particularly in a year where there's a decrease in prices, because we can do the Roth conversion, convert more shares because prices are down. And then when the recovery happens, more of it can happen in the Roth IRA. So expect, if we've done that in the past, or we've talked about it in the past that we'd do it this year, expect a call and some emails before the end of the year. Getting more out of your cash. So basically money that's not in your emergency fund. What do you do with it, right? There's kind of 3 options, and I'm putting them in order of what I would consider doing, right? So extra payments on debt with variable interest rates. So if you have credit card debt, that interest rate is going up pretty dramatically based on short-term interest rates. Pay that off as soon as possible, right? Once that's done, you might consider inflation protected bonds. So these are I bonds, savings bonds from the government directly. So you can go on treasurydirect.gov. I cannot buy these for you. You can buy them on there, and it's basically 10 grand a year per person that you can put into it. So 10 grand in 2022 for, if you're a married couple, for each spouse, and then 10 grand each in 2023. You each need your own individual account at treasurydirect.gov. If you have questions on that, let me know. But basically, they're savings bonds that are designed to keep up with inflation. So the interest rates right now are over 6%. And then dollar cost average into a diversified portfolio. So if you have cash on the sidelines and you've already done these 2 other things, right, it might make sense, and I don't know when markets will recover, but it might make sense to, if you've got 50 grand in cash, to do 10 grand a month for 5 months into a diversified portfolio, so that if prices recover in investments, you'll have had some of that money in the market. If prices continue to go down, you'll buy it at lower and lower discount or better and better discounts for the eventual recovery. So people ask me, is now a good time to get in the market? Well, the answer is always yes, right? Even when markets are going down or when markets are going up, because the expected return in both stocks and bonds and cash over time are positive, right? We don't know what they will be in the short term, but long term, they're all positive. All right. So what's next? We're going to continue to monitor markets. We're going to make updates like this from time to time. We're going to rebalance portfolio and manage cash as needed. If we haven't done a client review this year, feel free to schedule one. There's going to be some links in the email that I sent this out on that you can schedule a review, either a call or a more in-depth review, depending on what you have time for. Thank you for watching. My name is Josh Wolberg, Great River Financial. Stay curious, my friends.